Hey everybody, welcome to the Basis Points Podcast. I'm Kevin Flanagan, head of fixed income strategy at Wisdom Tree Asset Management. And we're talking about Treasury yields this week and how low can we go? It's no understatement to say this could have been the most anticipated jobs report that we got in quite some time. And it wasn't necessarily a referendum on whether the Fed would cut rates in a week or so. It was being viewed as perhaps the final input for Powell and Company. And the overall report did confirm labor market activity is cooling, but it also seemed to confirm New York Fed President John Williams' description of a no hire, no fire job setting. But when you look at it in terms of the upcoming FOMC meeting, in my opinion, the tenor of the August employment report confirms a 25 basis point rate cut. And is a 50 basis point rate cut completely ruled out? No, not necessarily. But Powell and Company have given no guidance on that front up to now. In fact, a negative payroll print would have made for a better argument for a 50 basis point cut. As for the remainder of this year, an additional rate cut, maybe two, is certainly now on the table. But once again, the Fed's decision-making process is going to remain data-dependent, with policy tilted more towards the employment aspect of their dual mandate. So where can Treasury yields go in this environment? You know, Treasuries rallied going into the jobs report, and the data provided the platform for this rally to continue post-release. And as a result, the 10-year Treasury yield has fallen to about 4.05% as I'm talking to you today. And the 2 years coming in under the 3.5 threshold. At these levels, the 2-year yield is fully priced for 3 cuts and actually fell below the low water mark of 354 that was registered following the Fed's 50 basis point rate cut at the September 2024 FOMC meeting. But when you're looking at the 10-year, we haven't experienced that same type of deja vu. You know, indeed, at this time last year, the 10-year fell to almost 3.6%. And that was based on the increasing recession odds at the time. We're not there at this point in terms of recession expectation. And that's an important consideration when trying to determine the upcoming movement in the 10-year yield. You know, rallies and sell-offs can often overshoot in either direction. And unless upcoming economic data shift the outlook for a potential recession, it would appear as if the 10-year rally could run out of gas. In other words, getting back to 360 would more than likely not occur. I think the key takeaway going forward is that Treasury yields don't necessarily move in the same direction or magnitude. And with the 10-year yield now flirting with the 4% threshold, there really is a little margin for error if the economy can avoid an outright downturn. So I'm going to end it there. I hope everybody has a great rest of the week and be well.